Hey everyone, welcome back to This Explainer. I'm your host and your virtual study buddy, and today we are going to crack the code on Chapter 6 of the Income Tax Act. We're specifically zeroing in on Sections 60 to 65. If you've ever looked at these provisions and felt completely overwhelmed, honestly, don't worry. By the end of this session, you're going to have a rock-solid understanding of these rules, and you'll be ready to tackle any crazy scenario your examiner throws at you.
All right, let's kick things off by understanding the why behind all this. You know how our income tax system is progressive, right? Basically, the more you make, the bigger the slice the taxman takes. Well, high-income earners quickly figured out that if they just diverted some of their wealth over to family members in lower tax brackets, like a spouse or a minor child, they could massively reduce their overall tax burden. But, the government caught on pretty quickly. Their ultimate solution to this little tax avoidance strategy is exactly what we call clubbing.
Here's our game plan for today's review. We'll start by defining clubbing, then decode revocable transfers, navigate those tricky spousal income rules, actually calculate clubbed income, and finally, run through a rapid-fire exam checklist. Let's get to it. All right, Section 1. What exactly is clubbing of income? Normally, you only pay tax on what you personally earn. Pretty straightforward. But Sections 60 through 65, they completely flip the script. You're not just taxed on your own earnings, but also on income you might, try to stash in someone else's name. If you transfer income without handing over the actual underlying asset, or if you transfer an asset with a bunch of strings attached, the taxman is absolutely going to take that income and club it right back into your total income. Now listen up, because this is the absolute ultimate flex for your essay questions. If you get hit with a question about complex cross-transfer schemes, drop the Supreme Court case of CIT versus Keshavji Morarji. Basically, if folks use a circuitous method, like say person A gifting to person B's spouse, and then person B gifting back to person A's minor child, the court says, yeah, no, we see right through that. Quote this case law on your exam, and you are literally guaranteeing yourself bonus points from the grader. Moving right along to Section 2, Revocable Transfers Explained. I always like to think of a revocable transfer as a gift with a boomerang attached. If you hand over an asset to someone, but the agreement lets you snatch the asset or the income back directly or indirectly, it's a revocable transfer. Or even if it just gives you the right to reassume power over it at some point down the line. The government's view is super simple here. If you kept the power to take it back, you never really gave it away in the first place. So boom, that income goes straight back onto your tax bill. Okay, take a really good look at the exceptions here under Section 62. Honestly, memorize this table. If a transfer is strictly irrevocable during the entire lifetime of the beneficiary or the transferee, it's generally safe from clubbing. But, and this is a massive but, examiners absolutely love to test this specific trap. Even if it's irrevocable for their lifetime, if you, the transferor, derive any direct or indirect benefit from that income in the meantime, the clubbing provisions snap right back into effect instantly. Okay, let's hit Section 3, Spousal Income Rules. This right here is the absolute meat of the chapter. We're navigating the tricky waters of spousal income under Section 64, and trust me, this is where examiners love to catch you off guard. Take remuneration, for example. If you've got a substantial interest in a company, and your spouse gets a salary from that exact same company, that cash gets clubbed with your income. But wait, here's the exception they'll try to trick you with. If your spouse actually has technical or professional qualifications, like, say, Mrs. Anamika is a legit software engineer doing actual work at her husband's IT firm, that income stays with her. No clubbing.
Now, you might be wondering, okay, what actually counts as a substantial interest? Remember this threshold, 20% or more of voting power. That's the magic number. In one of the textbook illustrations we looked at, Mr. Arun holds a whopping 55% voting power. Bam! That instantly triggers clubbing investigations for his wife's salary. Oh, and quick side note, transferring an asset to your spouse just for natural love and affection, yeah, tax law doesn't care about your feelings. That does not count as adequate consideration, so that income is absolutely getting clubbed.
Let's roll into Section 4, Calculating Clubbed Income. All right, picture a classic exam scenario. A spouse gives some money, and instead of just letting it sit in a boring bank account, that cash gets dumped directly into a business as a capital investment. Fast forward to the end of the year, the business makes a tidy profit. The big question is exactly how much of that resulting profit gets clubbed back to the spouse who gave the gift. Well, here's your foolproof three-step formula to figure it out. Step 1, figure out the value of the gifted capital. Step 2, figure out the total capital in the business. Step 3, find the proportion and multiply it by the profit. Simple, right?
But here is the absolute secret sauce to getting full marks on this. Always, and I mean always, use the capital values from the very first day of the previous year, like April 1st. Any capital they try to tell you was injected mid-year, ignore it completely for this specific calculation.
Let's actually apply this to a case study so it sticks. On April 1st, Mr. Rahul has 3 lakhs of his own capital in his business. His wife, Mrs. Radha, gifts him 7 lakhs, which he immediately invests. So total day 1 capital, 10 lakhs. Mrs. Radha's gift is exactly 70% of that total. So when the business turns a profit of 5 lakhs for the year, you take 70% of that 5 lakhs, which comes out to 3.5 lakhs. And that exact amount gets clubbed right back to Mrs. Radha. It's like a math puzzle, but once you know the rule, it's super easy.
Okay, heads up because this is a massive trap examiners set and students fall for it all the time. It's the concept of accretion. Let's say Mr. Karani gifts his wife debentures. The interest generated on those debentures definitely clubbed back to him. But if his wife takes that interest money, reinvests it, and makes more money on it, that second layer of income, the accretion, is not clubbed. The buck literally stops at that first layer of income. Actually, scratch that. There's a tiny exception involving minor children. But generally speaking, no clubbing on accretion. Write that down in huge letters in your notes right now.
And finally, Section 5, our rapid-fire exam checklist. When you're staring down a massive, confusing scenario question on exam day, I want you to fire these questions off in your head to instantly spot the clubbing provisions. Is there a sneaky clause to take the asset back? Club it. Is the spouse pulling a salary without any actual qualifications? Club it. Was the house transferred just out of love and affection with zero cash changing hands? Club it. Is it interest earned on reinvested interest? Don't club it. And if it involves a minor child, assume it's clubbed to the higher earning parent, barring a few specific exceptions like if they're a child prodigy. Run through this checklist and you will literally breeze right through the multiple choice section.
So take a deep breath, review those tables we covered, and ask yourself, are you ready to outsmart the examiners and absolutely crush Chapter 6? You've got the tools, you've got the case law, and you've nailed down the formulas. Keep this explainer handy whenever you need a quick refresher. Good luck with your studying, you're going to do great, and I will catch you in the